there's a silent moment that happens the moment your LLC starts making real money. You look at your business account balance and realize nobody ever actually explained how to take that money home. And here's the tension: the IRS has opinions about how you do it, and getting it wrong can mean tax penalties, audit risk, and thousands in unexpected liability. Most new business owners think drawing money from your LLC is simple. You just move cash to your personal account whenever you need it, right? That's technically true, but it's also where the system breaks down. In the next few minutes, I'm going to show you exactly how LLC owner withdrawals work, what the actual tax rules require, and most importantly, the one decision that determines whether you save thousands or lose them. Here's the promise: by the end, you'll understand not just how to pay yourself, but why the structure matters, and when you should change it. If you run any kind of small business, partnership, or side operation as an LLC, this applies directly to your situation. I want you to think about something first. When you formed your LLC, you probably thought about liability protection. That's the obvious benefit, right? Separating your personal assets from business debt, but there's a financial architecture inside that protection that most owners never intentionally design. In a minute, I'll show you the exact withdrawal strategy that changes how much tax you actually owe. But first, let's talk about why this feels so confusing. When you work a job, your employer withholds taxes automatically. You never see those calculations. They just happen in the background. As an LLC owner, you become both the employer and employee, which means you're suddenly responsible for that entire system yourself. No automation, no clear instructions, no safety net. This is where the anxiety typically starts creeping in. You've formed the legal structure to protect yourself, but the tax structure feels like quicksand. Here's what's actually happening underneath an LLC is what the IRS calls a pass-through entity. That term sounds technical, but it just means your business profits don't sit at the business level paying corporate tax. Instead, they pass through directly to your personal tax return, where you pay tax once on the income. That's different from a C corporation, where the company pays tax first, then you pay tax again on dividends. So far, that sounds favorable, and it usually is, but the pass-through structure creates this obligation. You must account for every dollar that leaves the business, and you must reserve money for self-employment tax before you withdraw anything. Most people miss that second part until April 15th arrives. Here's where it gets real. Self-employment tax is 153%. That covers your Social Security contribution and Medicare. The payroll taxes that would normally be split between you and an employer, except now you're paying both halves. The math looks like this. Net business profit to CRES 153%, equal sign self-employment tax owed. Let's say your LLC nets $80,000 in profit after expenses. You can just take the whole $80,000 home. You owe approximately $12,240 in self-employment tax alone, before any income tax on top of it. Most new owners don't calculate this until the tax bill lands, which is when panic sets in. The system requires discipline that nobody taught you. You need a separate business bank account. Not just recommended, but essential for the IRS to believe your business is real and separate from your personal finances. Many people commingle funds, meaning they use the business account for personal expenses or vice versa, and this creates what's called piercing the corporate veil risk. That means a court or creditor can claim your personal assets are fair game because you didn't maintain the separation. It sounds dramatic because it is. One business owner I'm thinking of, let's call him James, operated a consulting LLC for 3 years where he paid himself whenever he felt like it, never set aside taxes, and mixed personal and business spending routinely. The business was profitable, making about $120,000 annually. But James had never really paid himself in any formal sense. When tax time came, he owed $28,000 in self-employment and income tax combined, plus penalties for underpayment, plus interest. He also had no clear records of which withdrawals were legitimate owner draws versus personal expenses, which made an audit even more likely. This is the part nobody notices until it's too late. Here's the actual mechanism of how owner draws work in practice. You establish your LLC and obtain an EIN number from the IRS. That's your business tax ID. Then you open a separate business checking account in the LLC's name. Using that EIN, from that point forward, all business revenue flows in, and all business expenses come out. Your profit is what's left at the end of the month or quarter. Once you have a clear profit number, you can calculate your self-employment tax obligation and set that money aside. What's left is the amount you can actually withdraw to your personal account, penalty-free and audit-safe. Most states don't require you to take draws on any particular schedule. You can do it monthly, quarterly, or annually, as long as your records reflect when you took it and in what amount. The IRS only cares that you can prove it. That second part is critical. You need documentation. This is the twist that changes everything. The IRS doesn't automatically know whether you took a $10,000 draw or transferred $10,000 of business money to yourself as a hidden loan. The difference matters enormously for tax purposes. A legitimate owner's draw is taxable income to you, but it doesn't trigger additional tax at the business level because the business is passed through. A business loan to yourself is different. You're borrowing the money, so theoretically you owe it back, which creates timing issues and audit red flags if you never repay it. The documentation piece is where this gets expensive. You need a record of every draw, the date, the amount, and ideally a notation of what it was for. A business accounting system like QuickBooks or even a detailed spreadsheet with bank statements creates that trail. Without it, you're basically saying, trust me to the IRS. And they don't. Let me show you how this actually plays out across different types of businesses. Because the pattern is the same regardless of what you do. Take a freelance service business. Maybe you're a consultant, doing $120,000 annually in revenue with $80,000 in direct costs, leaving $40,000 profit. You calculate self-employment tax $40,000 to with 153%, equal sign $6,120 in SE tax. You set that aside, leaving $33,880 in available draws for the year. You can take $2,823 monthly, or $16,940 every 6 months, or split it however makes sense for your cash flow. The key is documenting each withdrawal. Now imagine a product business where you're wholesaling or drop shipping, same math applies. $150,000 revenue, $95,000 in cost of goods sold and operational expenses, $55,000 profit. $5,000, Triquo 153%, Trival Bodlu D and SE tax. Draw $46,585 safely for the year. The mechanism doesn't change because the LLC structure doesn't change. What about a property owner or investor? If you hold rental real estate in an LLC, the profit calculation is different. You subtract mortgage interest, depreciation, maintenance, property tax, insurance, but the draw mechanism is identical. Let's say a single unit rental produces $18,000 annual profit after all deductions. $18,000 times 153% equals $2,754 in SE tax. You can draw roughly $15,246 safely. If you're a software developer or you run an R&D heavy business, same principle, total profit minus self-employment tax obligation equals safe annual draws. Even a small manufacturer with employees still calculates owner profit the same way. Revenue minus all operating costs, including payroll, materials, and overhead, equals your draw eligible profit. The business type barely matters. The structure is consistent. What actually matters is whether you're intentional about it. Most people drift into this without a plan, which is where the consequence part emerges. If you're not reserving for self-employment tax, you're essentially taking money that legally belongs to the IRS and spending it on living expenses. When April arrives and you realize you owe $25,000 and you don't have it, panic follows. Worse, if the IRS audits you, they can penalize you for underpayment of estimated taxes, meaning you owe not just the original $25,000, but an additional 5–10% penalty on top. The stress compounds because you didn't plan. There's also a secondary consequence that matters less legally, but psychologically, you never actually know how much you're earning. If you take draws haphazardly, you can tell whether your business is sustainable or whether you're slowly liquidating it through over-withdrawals. This is the part that keeps new owners awake at night. Not knowing their own financial reality, most people miss this until they try to scale and realize they have no idea whether they can actually afford to hire an employee, expand, or invest back in the business. The relief comes when you set up a system. It doesn't have to be complicated. You need 3 things: a business bank account, a basic profit tracking system, even a spreadsheet works, and a decision about when and how much you'll draw each month or quarter. Once those 3 things exist, the anxiety almost entirely disappears. You're not guessing anymore. You're not stressed about audits because your documentation is clean. You're not scrambling in April because you already set the money aside. This is where the second part reveals itself. The S-Corp question. Most people hear about S-Corps in the context of paying less in self-employment tax, and they assume it's automatically better. Here's the reality: as your LLC becomes more profitable, that 153% self-employment tax grows with it. If you're netting $200,000, you owe roughly $30,600 in self-employment tax. That's real money, and it incentivizes the question: Is there a way to reduce it? This is where an S-Corp election becomes relevant. But it's not a simple yes or no decision. An S-Corp requires you to pay yourself a reasonable salary for work performed, and only profits above that salary are treated as distributions, which avoid self-employment tax. The trick is what's reasonable. If you run a marketing agency and you do $300,000 in revenue with $200,000 in profit, the IRS expects you to pay yourself a reasonable salary for the actual work you did. That might be $90,000, $120,000 depending on market rates for your role, and then the remaining $80,000, $110,000 could be treated as distributions and avoid self-employment tax. That saves roughly $12,000, $16,000 in SE tax. But here's the catch: you now have to run payroll, file additional tax forms, and pay state filing fees, which typically costs $1,000, $2,500 annually. The math only works if your profit is substantial enough to justify the complexity. As a rough threshold, if you're netting less than $100,000 annually, the LL structure is usually simpler and cheaper. Above that, it's worth exploring with a tax professional. Most people's mistake is assuming S-Corp is always better without doing the actual math for their situation. Results vary. The documentation piece becomes even more critical in an S-Corp, because the IRS specifically looks for whether reasonable compensation is actually reasonable or a disguised way to avoid self-employment tax. You need to be able to defend your salary choice, comparable market rates, hours worked, industry standards, all of it. This is why the mental shift matters. You're not just paying yourself, you're building a tax and legal architecture that protects you, documents your decisions, and holds up under scrutiny. Most people see this as bureaucracy and resent it. The reframe is this is actually what separates struggling businesses from stable ones. A business owner who documents their draws, reserves for taxes, and reviews their profit margins quarterly has information. Information is control. Let me walk you through what a clean system actually looks like, month by month. Month 1, your business brings in $15,000 in revenue, and you have $9,000 in expenses, leaving $6,000 profit. You calculate SE tax on that profit. $6,000 tax 153% equal sign, $918. You set $918 aside in a separate savings account or reserve within the business account. Call it your tax bucket. The remaining $5,082 is available to draw personally. You withdraw $5,082 to your personal checking and document it. Owner's draw. Month 1 profit distribution. Month 2 same process with whatever profit month 2 generates. By the end of the year, your tax bucket has accumulated all the SE tax you owe, and you have a clear record of every personal withdrawal. When January 15th arrives, you have the money ready, you file your tax return, you pay what you owe or get a refund if you over-reserved, and you move forward with clarity. The system sounds basic because it is, but most people never implement it, which is precisely why they panic. Here's the psychological piece that matters once you set this up. The anxiety about your business finances fundamentally shifts. You're no longer operating in confusion. You know exactly how much you can safely take home. You know whether your business is actually profitable or just moving money around. You can have real conversations with your accountant or tax advisor because you're coming with documented information instead of a shoebox of receipts. This changes your entire relationship with the business. Here are the 3 core things to lock in separate business and personal accounts to maintain liability protection and clean records. Calculate and reserve self-employment tax before taking draws to avoid April surprises. Document every withdrawal so you can defend your tax treatment and pass an audit. If you want to explore further, and I mean specifically if you're netting over $100,000 annually, have a professional analyze whether an S-Corp election makes financial sense for your situation, because results vary depending on your profit margin and operational complexity. The last bit of clarity: most people assume this is complicated because taxes feel complicated. In reality, the core mechanism is straightforward. You just need to do it intentionally rather than accidentally. The business owners who feel confident about their money situation are typically the ones who chose a system and stuck with it. They aren't smarter or richer. They just decided to know their own numbers rather than hide from them. That decision, made once and implemented consistently, solves almost everything you're actually worried about. If you're running an LLC and you've never actually implemented a draw system, the first step is simple. Open a dedicated tax savings account within your business banking, or keep detailed notes about what you've already withdrawn, and then consult with a qualified tax professional who can review your specific situation and advise whether your current approach is aligned with your profit level and goals.